Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer, co-founder of TheStreet.com, host of CNBC's Mad Money. Jim, welcome back.
Thank you, Aaron.
So the idea of these segments is to help you take a step back and let everyone get a sense of really what's going on behind the scenes a little bit here. And yesterday you were talking about the issue of the options hangover and how after the Friday expiration, and
it didn't play out.
It didn't play out. So how big of a negative is that?
Well, yesterday something happened that is just contrary to what everything that I've ever learned about the market. The market fell on two pillars. One was tech. Okay, well, tech's been up. NASDAQ late to the game. A lot of people feel that December is when you got to take profits in tech. But the other was oil. I mean, it's almost as if when oil goes down, the market looks bad. The oil stocks were, when a Chevron goes down a couple percent just like that, after taking forever to put that a couple percentages on, Exxon rolls over. The oils colored the market, the listed stocks, much more ugly. The NASDAQ, it turned out that, there were a lot of people betting that Oracle wasn't going to be any good. Oracle wasn't any good. It turned out to be a good call. And then the rollover in retail is quite surprising, given the fact that the products are hot, but the retailers are making no money.
Right, and the big story today, of course, Circuit City, a loss for the quarter, which surprised everybody. The stock's getting hammered today. We were talking before on camera about how the fact that there weren't people short Circuit City is making this decline worse. How does that work?
Right. Typically when you get, when Best Buy had its quarter that was so-so and then did the big guide down, I would have thought that a lot of people either would have bought puts on Circuit City or be shorted, and therefore when it was down a couple, they'd have to come in and cover. It looks like that trade didn't happen. It looks like that the short sellers are not creating that trampoline cushion underneath by having to come in and buy.
So the shorts, if you're short a stock and it goes down big, you're going to cover to take your profit because you don't want to be greedy. Right,
natural buyer down there. And yesterday I happened to have a lunch with 15 people who just cover retail, both buy and sell side. And only one guy ventured a short. I guess that should have been. Typically I don't like that kind of thinking, which is, everybody's long, so therefore it's bad. And the reason I don't like it is because I got in the market at 1,300 on the Dow. And there's been tons of times where everyone liked it. And it turned out to be right because the market went to 12,000. But this sector analysis was that it's right in my face that the day after retail's just hideous.
Right. And we haven't gotten much good news out of retail this whole holiday shopping season.
No, remember, this was very weather dependent. I just hear so many bad things out of Federated. They're long a lot of stuff, particularly in the May division. I think that there was a perception that a lot of big screen TVs were going to be sold, and they were, but no one made any money off of them. So that that doesn't mean you should avoid big screen TVs. There's probably components that work. Although Corning, I was gratified to see that there's going to be a new Asian phone line built because that's going to use a lot of fiber. But in general, this has been a bad bet. And the thing that's the worst bet about the TVs is that Costco's come in and upset the pricing. And I think people are shopping at Costco. Right. Remember, that has been the one good quarter that has surfaced during this period.
And it is good for the consumer, obviously. These prices are coming down.
Right.
And I love Costco myself.
Right, I do too. And I think this is, I've been saying to people that, Senegal, who's actually the oldest, he's the CEO, the oldest of the major active CEOs in retail, has figured out a great bargain with the consumers. And it's kind of, it's what people used to think about Walmart. We used to think, Walmart's moving in, you got to sell all the food company, the supermarkets.
Right,
Walmart's moving into apparel, you got to sell the apparel. It turned out to be Costco's got the better model because that's actually attractive to middle and upper income.
Interesting. So you did mention Oracle earlier. And
right. Oracle's
the software license revenues were not as good as people thought. But how much of this is the fact that stocks went up 45% year to date?
A lot, but this is, let's use both Oracle and Circuit City as metaphors. One of the things that's happened in the market was we developed some consistency where there used to be inconsistencies. Circuit City used to be a very inconsistent company, and then we just kind of got used to them hitting their number, beating their number. Oracle had become a consistent company, and now this is very inconsistent, which means that you not only get lower earnings, but you get a lower multiple as people just say, you know what? Give me Cisco.
Right, because there's a lot of talk that maybe the past two quarters, which were blockbusters, were the anomalies instead of a new pattern. That's the fear.
The acquisitions pumped up the earnings, and now we're seeing the beginning of the end of the acquisition gains, and that makes people less comfortable in Oracle. Look, anytime the stock had a run, you could say that it's due for profits, but Cisco had a big run, and it didn't come down, so I look at it like that.
Fair enough. Okay, and going back to yesterday also, we were talking about the Fed and what's going to prompt the Fed to possibly cut rates, and you were talking about the idea of a crisis, and we were talking, you mentioned Ford, but we were talking metaphorically about what happened in 97, 98. Right. Then this morning we wake up and Thailand's getting crushed because the government's, instituting these controls on short-term capital in
Right.
the country. They since have already backtracked for stocks, but is that the kind of thing that reverberates out, becomes a bigger issue for emerging markets?
I think the emerging markets have been uniquely buoyed by two equally stupid forms of money. Leveraged hedge funds who just always just can't resist shooting the lights out so they can get more money, and that's a time-honored prospect. Hedge funds being completely and utterly reckless and winning, because you can win in that game if you have a shoot the lights out year and get money come in, which is all these guys really are after. I don't mean to be totally. I mean, there's probably some hedge fund out there that isn't playing that way, but the international guys know. And then the second thing is retail comes in very aggressively and sees the big returns and throws money at it. And these are both hot money. And I always hate to be where the hot money is, because you wake up one day, as we did today, and boom, it's out. This will cause, again, the reverberations. It's very interesting. There's a trial in Colombia. It's on the front page of the Times that could be bad for the government. And I was looking at Banco Colombia up here at 31. I'm thinking, well, that's just you sell that stock right here. Latin America is a trade.
Interesting. And so more generally, as you mentioned, a lot of retail investors have put money into emerging market
yes, they
funds.
have. They can't resist.
Big numbers. And you've been
Turkey
for last year. So you're saying you want to be selling here?
I want to be a trader of those markets. I find that when you have a stock like Banco Bradesco and you catch a double, you know, I don't really care where it's going to go from there. That's a different kind of animal than Bank of America. And people don't realize that those stocks are all bought, many of them are bought with borrowed money. So the moment things go bad, they just pull the plug. You can't. Here's what I put it. You can't get comfortable with those markets, and if you are, you're going to lose money.
Okay, fair enough. And last question. It seems today is a little bit of an inverse of yesterday. We had a lot of good news, M&A activity, and the market didn't do much with it. Today there seems to be a lot of bad news. We also had some data that suggests the Fed isn't going to ease.
Right.
You know, the PPI higher than expected, housing starts rebounding. That's not going to give the Fed any concern about real estate. And yet the market, as we're talking now about 11 o'clock, is hanging in pretty well.
I look at the market and I think it should have been up yesterday. It's down today. There's a lot of short-term, and then it bounces back. There's a lot of short-term gyrations in the last 10 days of the year. There's a lot of repositioning that goes on. The market is thinner than it should be right here. Witness the fact that when the two big mutual funds that have been buying the oil step away, boom, big vacuum. Right. I would urge people to take advantage of big dislocations if the fundamentals are good. Let me give you an example. When I see the dislocation in Marvell Tech, which I've been buying for ActionAlertsPlus.com, it's very clear we're going to be using a lot of controllers. They're working off the inventory. Everyone knows that Nintendo's hot. I mean, these are naturals. These are the component plays versus the Circuit City Best Buy plays. But they get pulled down by Oracle, too. So, I mean, what I say is look for the collateral damage and buy that. In the same way that in oils, it's natural gas that's driving things down. So go buy the companies that are only levered to oil and not nat gas, and they will come back faster. Now, longer term, why didn't I buy Devon here? So I think I'll look back and say, well, but because it's nat gas and the people are now starting to pull the trigger.
The weather's really warm and everyone's already worried. Right.
We'll come in 2 weeks from now and it'll be really cold and I'll say, oh man, Devon's at 73 and it's at 67. Why didn't I think it would ever get cold again? But the pain on these stocks, I mean, Devon's come from 75 down to 67. That's a slide that most people can't handle. So what you do is you end up saying, okay, buy a little Devon, and if it comes down again, buy more. But if it gets cold, flip to Devon. And I think that's the kind of trade I like.
Okay, one more question. It's similar stock. Anadarko has been getting killed. And
suddenly it's out of favor, man.
Right. I talked to Chris Edmonds about this last week, and he thinks you bet on Hackett and that management team for the long term.
I like the Chesapeake more because it's 2 points below the deal, so people are furiously going to kick it out between here and year end. And Chesapeake's very well run and hedged. Look, I'm never going to disagree with Chris. I just think that Chesapeake's better than Anadarko.
Okay, Jim, thanks very much.
Thank you.
I'm Aaron Task. Stay tuned for more Street.com TV.